All right. Well, thank you, everyone who's joining us. My name is Jim Kirsch. I am with Kelly Cawthorn, and thank you for joining us for this webinar to talk about the One Big Beautiful Bill Act. And our client we work with is Raymond. Excuse me, they've been around for 80 years, accounting and business solutions they provide. I got Tony Licavoli, Paul Meany, and Michelle Hodges joining us today. Thank you, everyone. I will turn it over to Tony so he can get right into his information he would like to provide on the One Big Beautiful Bill Act, and we'll go from there.
All
Tony,
right. Thank you,
thanks for
everyone. Thanks,
joining us.
Jim. Yeah, can you just
Mhm.
confirm, Jim, you can see my slides?
Yep.
Perfect. All right. Yeah, again, good afternoon, everyone. And as Jim said, welcome to today's presentation. We're going to be unpacking the newest piece of major tax legislation, and that is the One Big Beautiful Bill, or what we'll refer to today as OB3. So just doing some quick introductions here. My name's Tony Licavoli. I am our Director of Tax Consulting. And with me, I have Paul Meany. Paul is a leader in our credits and incentives team, and also Michelle Hodges, who's a principal in our public sector solutions group. So how we have the presentation kind of broken out is in three main sections here. Paul and I are going to cover the business and the related individual tax provisions in the first two sections. And then we'll turn it over to Michelle, who's going to focus on covering the not-for-profits. So we'll be covering basically the full spectrum of kind of who was impacted by OB3 here. So before we get into any of the specific provisions themselves, we'll start off with a little bit of background, kind of how we got to the passage of the OB3. And really to do that, we have to go back several years to 2017. And that is the year that the Republicans passed the Tax Cuts and Jobs Act, what we call the TCJA. So that was probably the most significant legislation that we've had on the tax side in about 20 years back in 2017. So it included items like the corporate tax cut, so corporate tax rates going down from 35% to 21%. It included all of the individual tax cuts as well. They were all part of the same bill. Now, one thing about the TCJA is it was not a bipartisan effort. So again, I mentioned it was a Republican tax bill. And in order to get that passed through the House and specifically through the Senate, the Republicans had to use a process called reconciliation. And this basically avoids the filibuster, the 60 vote rules requirement in the Senate. Now, with reconciliation, there is certain budgetary rules. And, basically, in order to get this bill passed, most of the individual or the non-corporate tax changes from 2017 had to be temporary provisions. So they were not permanent tax provisions. So this fast forward to 2025, and we were looking at the expiration of all these 2017 tax cuts for individuals. So we had about $4 trillion worth of tax increases that were going to hit individuals if Congress didn't do something to act. So that really sets the stage for the election in last November. The Trump campaign had focused heavily on campaigning for extending all of these individual tax cuts. And, again, fast forward a little bit, we knew what happens at the campaign, right? The House and the Senate are both won by the Republican parties, as well as the executive branch, too. So now we're back. Now we're into January of this beginning of this year. And what, one of the immediate things that starts getting discussed at the beginning of the year is the extension of these TCJA tax cuts. So the Republicans basically start crafting a bill that gets us into April and May. The Republicans in the House narrowly pass their version of the bill in May. It makes its way over to the Senate, and the Senate Republicans take it up and basically make some fairly significant alterations to the House bill they ended up moving back on or giving it on a few of them just to make sure that when they send it back to the House, that got through there. But the House did, or the Senate did um, make some significant changes from the House bill. So again, we're in June now, towards the end of June. The Senate passes the bill, goes back to the House. The House signs it, and it gets on the president's desk and is signed on July 4th of this year. So basically, we went from no tax legislation at the beginning of the year to a fully fledged out and significant tax bill, including that was just one item in this legislation that was passed. There's a bunch of other provisions that kind of dwarf the scale of the tax provisions in this bill. So, within 6 months, we've got new legislation, which is, as fast as you're going to get when we're talking about getting something through Washington, D.C. So that kind of sets the stage of the background. Now, what's actually in the bill itself? So we kind of think of it as maybe three different buckets here. We've got what I just talked about, the TCJA extensions, right? That $4 trillion of tax increases. So not only were most of the individual provisions extended, but they were actually made permanent. So like the individual tax cuts, those are now permanent provisions, meaning Congress would have to do something enact order to change those tax rates. So that's the first kind of bucket. The second bucket is the campaign promises. So these are different things that were brought up during the Trump campaign. They tend to receive probably the most attention in the media. And those are areas like, no tax on tips, no tax on overtime, no tax on Social Security. And, as we'll talk about, we didn't get that, but we got a version of that we'll cover a little bit in the individual sections. And then the other thing just on there, sticking with the campaign promises, is U.S. manufacturing. So, the Trump campaign focused heavily on U.S. manufacturing and finding ways, or at least campaigning on ways to incentivize it. And as we'll talk about a couple provisions in this tax bill that are specifically targeted for U.S. manufacturers. Then the third bullet point on that slide, the other items, that's basically anything that doesn't fall into the first two buckets. And those include some of the more controversial areas like the SALT cap or the repeal and phase down of the green energy tax credits that we'll talk about. So with that, we're going to get into some of the actual specific provisions. So Paul, I'm going to turn it over to you.
So the first one we want to just kind of touch upon is the qualified business income deduction. So sometimes you'll hear it referred to as the QBI deduction. And so I think the biggest impact from OB3 is it's now made permanent. So let's kind of unpack this a little bit more though. So sometimes you'll hear it referred to as Section 199A deduction, but essentially, right, the provision allows owners to pass through businesses such as an S corp, partnership, LLC, sole proprietor, and to deduct up to 20% of their business profits on their personal tax returns. So it was kind of one of those more marquee features from the TCJA to give non-corporate businesses a tax break, especially because the corporate tax break back then went from 35 to 21. So this was kind of like the flow-through equivalent, but it was set to expire after 2025. So really, the OB3 steps in to remove that sunset, so that this 20% write-off doesn't disappear. So what does this essentially mean for if you're a business, right, or you're an investor in a pass-through entity? It means you can continue to take a substantial deduction, right, on your share of business income each year indefinitely, or at least until maybe another bill is proposed. So again, right, for your high-level executives, your owners, this keeps kind of your effective tax rate on pass-through income lower than what it would have been without the deduction. So the next one is bonus depreciation. And so bonus depreciation is back to 100% expensing. So I'm sure many people are familiar, right? We've had this phased down approach, but now we're allowed to go back to immediately deducting, right, the full cost of eligible assets like your machinery, your equipment, your computers, certain vehicles. So as I said, it was phasing down after 2023, but OB3 reverses that and makes full expensing permanent starting in 2025. There is, however, kind of one odd transition. So assets placed in service on January 1st to January 19th, 2025 only qualify for that phase down 40% bonus under the old law. And that has something to do with the election that just occurred and the timing of all that. But we are now essentially right back to the full 100% write-off indefinitely. And so really kind of that impact is pretty straightforward, right? So major purchases can now be fully deducted up front, right? Which ultimately, I guess, ultimately results in, right, boosting cash flow or lowering your after-tax cost of investment. And I think one of the other pieces to note is, right, alongside bonus, you still have Section 179 expensing also that got expanded under OB3, and it raises that threshold from $2.5 million to $4 million. So it gives small and medium-sized businesses much more room to kind of immediately expense equipment. So your Section 179 is an elective and is limited by taxable income. So it is ideal for targeted planning. So essentially, right, you're trying to think about, all right, Section 179, you choose the asset that's capped at 2.5 million, limited by taxable income. And then you've got your bonus depreciation, right, where it's automatic 100% expensing and then or deduction, and then no dollar limits, and that can create or increase a tax loss for you.
Yeah, and just Paul, as Paul said, this is one of the more significant of the business provisions that was included in here. So, if you think about in terms of the range of industries that bonus depreciation impacts, it is most businesses, right? Most businesses are buying and expensing fixed assets at some point. Obviously, certain businesses more than others. But most businesses are impacted by this. So, as we see when we get to the slide that shows the actual cost of some of these business provisions, you'll see that bonus depreciation is the most expensive of the business provisions that we're covering today.
So OB3 didn't really stop at just kind of the equipment, which is related to the bonus that we just talked about. It also kind of introduced what would be argued as kind of a brand new incentive where there hasn't really been something of this sort allowed in the past, where it's the immediate expensing of certain commercial building costs. So this is referred to as the qualified production property deduction or QPP deduction. And basically, in simple terms, right, if you build or invest in a facility that you're using for domestic manufacturing or other specified production activities, you can deduct 100% of those construction or improvement costs right away. So just like bonus depreciation, but for your structures, your non-residential real property. So under previous law, right, a building like a factory or a warehouse would have to have been depreciated over 39 years. But now, potentially, it's only in one, you can take it all in 1 year. And so this is a significant tax break aimed at encouraging domestic production and capital projects. Now, there are, some important qualification conditions to know. Again, right, means non-residential real property, commercial buildings that are used as an integral part of, right, that qualified production activity. Well, you might ask, all right, what is that qualified production activity? Typically, it refers to your manufacturing, your production, your refining of tangible products. So again, think of your factories, your manufacturing plants, your processing facilities, where you are making the stuff. But what is really interesting is there are some exclusions even when you do fall into those categories. So not every part of that building may qualify, right? There might be portions of that property or used that are unrelated to the core production activities themselves. For example, not just your sales rooms or your cafeterias, but also your R&D labs. So it is one of those situations where we're focused really on the production aspect. But again, right, it affords, commercial properties, the 100% write-off, and again, aimed at the production area specifically. So again, right, this is where you need to think about the original use and timing. Another aspect is, right, you have to own this. So no related party or leasing is eligible for this benefit.
Yeah, so just a couple of things on this slide too to talk about. I'd mentioned earlier that one of the kind of tenets of this tax bill was finding ways to incentivize U.S. manufacturing. Obviously, this does so by allowing for that basically that full write-off of the facility itself. The other thing on this slide here is kind of digging in a little bit more on a qualified production activity, a QPA, because this is a kind of a key part of this provision. This is one area where we're going to need some type of guidelines or guidance from the IRS and Treasury on, there's, kind of the way we see it right now, there's going to be a spectrum. And on one side of the spectrum, you're going to have entities that and businesses that clearly do qualify. Let's say it's an auto manufacturer that's taking a bunch of components and assembling a vehicle. Well, clearly, substantial transformation is taking place there. So that's one side of the spectrum. And the other side of the spectrum, you're going to have companies that are clearly not going to qualify, right? Think about a distributor, someone that is just simply, acquiring goods for resale and maybe just repackaging. They're not, there's no transformation to that product. Well, those are going to be entities or businesses that do not qualify. And then you're going to have everyone else in the middle. And that's where, we'd like to see some type of guidance from the IRS. So, let's say you are acquiring components and doing some type of minor alteration to those components and then moving them along the supply chain. Is that going to be considered substantial transformation? So, those are one of the key items in this provision that, we're waiting on some type of guidance from the IRS.
And Tony,
So I think one of the key takeaways of this.
Oh, go ahead, Jim.
Yeah, Tony, real quick. What time frame? I know we're not going to Q&A and everything, but like waiting on for some guidance. What's the time frame expecting that?
So, the Treasury is right now, obviously, there with the shutdown and all that. There's a lot of priority guidance, and this is not one of them right now. So they have been focusing on things in areas like overtime, things W-2 type stuff that's going to impact a much broader base. So that's what they're focusing on now. I have not seen a timeline for when they'd get guidance out. This provision is in effect right now. And so, hopefully we'd like to see something over the next couple months.
Okay, thanks.
So kind of just one of the key takeaways regarding QPP is basically if you're in the industry, right, that produces tangible goods, especially as Tony was kind of outlining some of those potential areas, again, the manufacturing, agricultural processing, refining, OB3, not just in this instance, but across a lot of these changes, right, is essentially saying, putting a sign up saying, invest here in America or in the American industrial sector, right? So I think this is one of those situations where it's important for companies to evaluate, right, their capital projects and their pipelines, projects that maybe we didn't pencil in before now maybe make sense based on some of these incentives and the ROI and the timing that could occur there. So again, I think it's important to keep an eye on the qualifying criteria. The documentation and planning will be needed to ensure, right, the project is going to meet these specifications, especially regarding, say, even the QPA. But this will allow you to kind of maximize the qualifying costs. So again, right, it's a matter of bifurcating between, right, what are eligible, what are not, but also understanding, right, these are significant tax benefits one can take advantage of.
Yeah, and just sticking with that idea of separating out qualified versus non-qualified. We put a slide in here about cost segregation. So cost segregation studies, as depreciation becomes more beneficial with things like 100% bonus depreciation or QPP, cost segregation studies become that much more beneficial for taxpayers. So what a cost segregation study is basically at its simplest form is, basically engineers would come out to your location, your facility, and they would look at the blueprints of the building, take pictures, and determine which portions of that building are eligible for a shorter depreciable life. So a 5-year, a 7-year, a 15-year life. And the benefits of that is not only is it shorter depreciation, taking over a shorter life, but anything under 20 years now qualifies for 100% bonus depreciation. So if you look at this basic example here, let's say we've got a new non-residential building. Let's say it's a manufacturing facility that cost $5 million. So typically you would depreciate that building over 39 years, or really 40 years if you looked at the depreciation rules. So you see that scenario one here, this is what you would get every single year in a rounded number for the next 40 years for depreciation for that building, $125,000 or so a year. Now, let's say in scenario two, you do a cost segregation study on that building. Now we've got 100% bonus depreciation, and that cost segregation study determines that 30% of the cost of the building is eligible for a shorter life. So now you've got a first year depreciation of over $1.5 million, right? A significant jump from scenario one. So then let's go to scenario three, right? I said it was a manufacturing facility. So layer on qualified production property into this. And that qualified production property is determined to be 80% of the cost of that building. So you depreciate 80% immediately, and then you would do a normal cost segregation study on that remaining part of that building. So your first year depreciation goes up to $4.3 million, right? Over 80% of the cost of that building, just by doing a cost segregation study with these new rules. So obviously a significant change in that cash flow analysis that you're doing when analyzing the cost of that building and whether it makes sense to invest into it.
So we've talked about some deductions for income through QBI, and we've talked about deductions through investments via bonus and QPP. Now we want to kind of shift to another limitation that OB3 addressed, which is interest expense deduction. So if your company carries significant debt, you're likely very familiar with the business expense limitation under Section 163J. But essentially, this rule brought in by the TCJA limits the amount of interest expense a business can deduct in any given year to a percentage of its income. So originally, from 2018 to 2021, the limit was 30% of EBITDA, so earnings before interest, taxes, depreciation, and amortization. But starting in 2022, it was tightened to 30% of EBIT, so earnings before interest and taxes, and then after depreciation and amortization, which was a harsher limit because not adding back depreciation means smaller income bases to measure that 30%. So many capital intensive or highly leveraged businesses saw their deductible interest drop due to that change. Now, the OB3 basically permanently restores the EBITDA-based calculation for your 30% interest limit. So in simpler terms, right, when we're figuring out how much interest you can deduct, you're allowed to now add back depreciation and amortization as you historically had been able to back to your earnings. So this tends to increase, right, the cap significantly, meaning more of your interest expenses become deductible. So why does this matter to you? If you're a company that has a lot of, say, interest expenses, again, you may be common in your real estate, maybe your private equity firms, or businesses that finance a lot of operations with debt, you'll now have an easier time deducting all of that interest. So fewer companies will necessarily hit that 30% EBITDA, whereas they might have with the 30% EBIT. So again, right, this means potentially lowering taxable income and taxes for heavy or highly leveraged companies. And while we're on the topic of deductions and reporting, right, we just want to briefly touch upon the compliance relief under OB3 for 1099 reporting thresholds. So many of you might have been following, right, the recent changes around the IRS reporting for payments. Well, this law has increased the reporting threshold, right, for your contractors to $2,000 adjusted for inflation. So in practical terms, right, this means that if your businesses pay an independent contractor or a service provider, you won't need to issue a 1099 form unless you paid them at least $2,000 in the year, up from the threshold of $600 previously. So again, this is just one of those kind of administrative aspects that does reduce paperwork for smaller transactions, which hopefully will help a little bit.
Yeah, just one thing to point out here, this 1099 threshold does take effect in 2026. So for 2025's reporting due in January of next year, you still do have that lower $600 threshold.
So energy tax credits and incentives. So one aspect of OB3, right, is there were significant rollbacks or trims to some of the clean energy tax credits that were expanded significantly just a few years ago under the Inflation Reduction Act in 2022. While the focus today is on business taxation, many companies were or have been, or at least thought to be, involved in projects or purchases that rely on these energy credits, whether it was installing solar panels on facilities or buying electric vehicles for a fleet or developing maybe renewable energy for projects. So we think it was important to at least touch upon the landscape as far as how it's changed. So in essence, OB3 accelerates some of the phase outs and terminations of multiple energy incentives. For example, your residential energy credit and your residential clean energy credit, which homeowners and builders use for things like installation of your efficient windows, solar panels, geothermal, were supposed to last in the 2030s, but essentially OB3 ends these much sooner. Home improvement credits end after 2025, so we're getting near to the end of that. Residential clean energy, things like that, terminate expenditures after 2025. So for a business, right, those generous clean energy tax breaks that we've now become accustomed to have now been pared back a little bit. So if your company was planning to invest in, say, solar installations or energy efficient upgrades, right, or electric vehicles for the expecting these federal tax credits, you'll now need to kind of reevaluate those timelines and ROI calculations. So many of them will be gone or reduced after 2025 or 2026. So really just kind of here to say this is kind of a last call if you're trying to get some of these, incentives when you're investing in these energy projects.
Yeah, and Paul, you'd mentioned businesses, but also with the Inflation Reduction Act that created a lot of these tax credits. There was an option for nonprofits and governmental entities, states, cities, to take advantage of these energy credits too through a process called direct pay. And again, these the phase outs do apply for not just the business side of the credits, but also any of the nonprofit sides that are going to utilize direct pay.
So another one of the impactful changes under OB3 that basically is to help incentivize, right, U.S. development, manufacturing, whether it's tech firms, manufacturing, or any other R&D heavy industry, was the return of immediate expensing for domestic R&D costs. So beginning after the 2024 year, so essentially January 1st, 2025, going forward, businesses can once again deduct all U.S. based research and experimentation expenses in the year in which they occur. So this essentially is reversing the TCJA rule that started in 2022, which forced as a mandatory compliance effort companies to capitalize and amortize research and experimentation costs over 5 years if they're U.S., 15 years if they were foreign research. So to put that into perspective, right, under the old law, if you spend $10 million on U.S. R&D in 2023, you could only deduct $2 million per year over 5 years. Under the new OB3 provision bill, right, that same R&D investment made in 2025 and beyond are fully deductible immediately, right, which ultimately restores cash flow benefits, strongly reinforces, right, the government's goal of promoting innovation. So it's important to note, though, that this is, again, only applying to domestic R&D. So if you're foreign research and experimentation still must be amortized over those 15 years. So creating a permanent distinction that may influence where companies choose to place labs, engineering teams, development teams, tech centers, things of that nature. So businesses will still have the option to capitalize for domestic R&D if they prefer, maybe if there was some smoothing income over time. But in practice, right, the majority will then kind of take that immediate expensing because it will be far more advantageous for most taxpayers. If you're a small business, OB3 also provides some additional relief by providing some retroactive relief, which is companies with an average gross receipts of $31 million or less over the prior 3 years, and this is inflation adjusted, can retroactively deduct, right, the R&E that they were forced to capitalize from the 2022 through 2024 time period via an amended return. And so a lot of times, if you don't want to take that, there's also an option where, right, you can essentially any unaccrued amortization from those 22 through 24 years, you can then take over 25 or spread out between 25 and 26. So again, across the board, companies should just kind of reassess, right, their budget, R&D budgets, right? They can kind of now start to forecast lower effective tax rates and review a lot of their R&D projects back to January 1st, 2022, right, which can, essentially help determine, right, whether we should be investing in new capital projects or incentives. And so the last thing I want to note here is, right, it didn't modify the R&D tax credit, which kind of is not the same. They share a similar but not identical definition to that capitalization requirement we were talking about, where it restored those deduction rules. But immediate expensing does not necessarily eliminate the ability to claim the credit, right? So think about it. If you're involved in these development activities, you're now able to get back to taking expensing or deducting those R&E costs and getting that tax credit, which is a dollar for dollar savings against a company's tax liability. The other thing to note is the reinstatement of the Michigan R&D tax credit. So Michigan has made kind of two major moves that will matter for anyone conducting R&D here. The first is as of January 1st, 2025. The state, right, is reinstating the R&D tax credit, giving new companies incentives to perform research within Michigan. So if you're a large taxpayer, you can claim 3% of qualified R&D expenses up to their base amount, while small companies receive 3% up to their base amount and 15% above. Potentially an additional 5% bonus for partnering with universities or qualified universities to kind of, if you're in the tech or biotech industry, right, partnering with them. So qualified expenditures largely mirror the federal definition. The program will have a cap of around $100 million statewide, with 25 million reserved for small businesses, meaning credits may be prorated. This will be the first year we'll see it in 2025, right? So just because you apply for, say, $100,000 state credit because of this pooled system doesn't necessarily mean you'll get it. Doesn't mean you won't get it, but we'll have to wait and see this first year to see what those prorations look like, how many people apply, what those credits are. So this new credit really does strengthen Michigan's competitiveness and can significantly cut state bills for innovative companies. One key administrative step, though, businesses must file a tentative claim by April 1st, 2026 in this first year to lock in your eligibility for those 2025 expenses, and they will not accept late filings. So if total claims exceed the statewide cap, again, Michigan will prorate the credit and issue a general notice. So bottom line, if you conduct R&D in Michigan, starting to plan now, capture these incentives, coordinate right with your federal R&D strategy in 2025 and beyond.
Yeah, so Paul mentioned or talked about the kind of the taxpayer favorable Michigan provision or for businesses, which is the new R&D credit. Now let's kind of talk a little bit about what Michigan's done over the past month and a half or so, which were some unfavorable taxpayer provisions. And so what they have done with their newest budget bill was basically decouple or not follow a lot of the business federal tax changes that we just discussed. So for example, bonus depreciation. Well, for the state of Michigan purposes, you are not able to utilize bonus depreciation. Now, for corporations, they are used to this. In the past, they have not been able to take bonus depreciation in the state of Michigan either. But going forward, these rules will apply to pass-through entities as well as corporations and partnerships here. So that is a significant item. Along with the second one on there, Paul just talked about the benefits of the R&D credit in Michigan. Well, for Michigan tax purposes, although you may be able to utilize the Michigan R&D credit, you are going to have to go back to or continue on with capitalizing your R&D cost that basically the federal tax law just removed that requirement. State of Michigan is going to still require you to capitalize R&D costs. So you combine those two provisions right there, and you may have, especially in the next 2 years where you're going to be able to write off old R&D costs, you may have a significant federal tax loss. And when you recalculate it for the state of Michigan purposes, you may have significant income. Again, the same tax year, the same company, two very different results here. And so, the important thing on this slide is when you're looking at any type of tax projections, any type of estimated tax payments, you need to factor in for the state of Michigan and any other state you are operating in as well, whether or not they're going to comply with the federal tax changes for the OB3 that we just covered, because many states are taking the position or passing laws that they are going to follow their own set of rules primarily for their own state budgetary reasons. And that is going to result in situations where you're going to have wild swings between federal tax losses and state tax income and state tax due as well. So the last topic before we get into some of the individual provisions that I wanted to cover, it can kind of fit in either the business side or the individual side, but that is 1202 qualified small business stock or QSB stock. And so, for those not aware of it, this is, a really powerful tax benefit that shareholders of C corporations can take advantage of. So you can't take advantage as an S corp or a partnership owner, but C corporations can take advantage of. And there's a ton of requirements that go along with it, but basically the benefit at the end is you may be able to sell that corporate stock tax-free, potentially 100% tax-free at exit. So what OB3 did was basically enhance a lot of those benefits. Again, you can read them off the slide here. We're not going to go through them, but anyone who's operating as a C corporation, and really we're talking about closely held C corporations. If you haven't looked into 1202 stock, you really do need to look into that because that is a substantial tax benefit down the road when you go to sell the business. Okay, this slide here, it's just an overview of the cost of the different provisions. As I mentioned there, bonus depreciation is top on that list, 362 billion. And you can see some of the other provisions on there as well. Okay, so we're going to switch gears a little bit. And for the next 10 minutes or so, we're going to talk about the individual tax provisions. Now, there is several slides that we're going to move quickly through. We wanted to include them on here. We'll make the slide deck available just for your own purposes. But for the sake of time, we're going to, kind of skip through some of these slides and focus on the ones we feel that are most important. So Paul, I'll turn it back to you.
Yeah, so regarding kind of the individual tax provisions here, I think one of the important things when we think about this benefit here is really just we're not shifting what we thought the post-tax provisions would be. And so really just kind of informative as far as your tax brackets are really not going to change significantly. Again, it maintains your top marginal rate at the 30%, 37%. So similar to what you heard from the business side, you're also going to just kind of see where we're just kind of keeping maybe what those rates were historically. And so you're not going to see, and you get that permanency there.
Yeah, and just again, so this slide shows what the change was after 2017 tax law changes. So these amounts are actually higher. I think the top tax bracket is at this point closer to $800,000 than it is $600,000. But you can see what would have happened if the TCJA tax cuts were not extended. You would go back down to these old rates in the second column here. These old ranges in the second column, as well as these old tax rates here, which would be unfavorable to the taxpayers.
And so the next change is the standard deduction. And so this one's pretty straightforward. It's straightforward, but meaningful. So basically OB3 permanently extends, the higher standard deduction that was introduced under TCJA. So really just ensuring, larger write-offs don't expire. So starting in 2025, the deduction really also just gets this extra inflation adjustment. So it increases from 31,500 for joint filers and 15,750 for single filers, with those amounts continuing to rise automatically each year with inflation. So at the same time, the law kind of repeals personal exemptions. And so basically keeping in place TCJA framework, where it is higher standard deductions replacing those exemptions. So the result is kind of a simpler filing structure and continuously broad tax relief with a larger upfront deduction for most households.
Yeah, and the interesting thing about this provision is, we were talking about the most costly one on the business side being in the billions. Well, the extension of the standard deduction and the increased amount is actually in the trillions of dollars in terms of its cost. And you can see why, if you look over on that right-hand side of the slide, 88% of taxpayers utilized the standard deduction and 70% utilized it even under the old the pre-TCJA lower amounts. So you're basically, and actually the amount actually today is closer to 93 or 94% that utilize it. So you've got the vast majority of US taxpayers that benefit from this increased standard deduction.
So, kind of another change, right, is the child tax credit, which gets a little bit of a boost. So, beginning in 2025, the child tax credit increases up to 2,200 per child. And importantly, that amount will now be adjusted every year for inflation. So it continues to rise over time rather than staying flat, which is really important. And the other piece is the alternative minimum tax, or you'll hear it referred to as AMT. But essentially, right, it's a parallel tax system designed to ensure, right, higher income taxpayers still pay some sort of minimum level of tax, even if they have significantly higher deductions or credits. So OB3 essentially permanently extends, right, as we've talked about, this is kind of a reoccurring theme here, but permanently extends the higher AMT exemption amounts and phase out thresholds that were introduced under the TCJA, which essentially, right, keeps them indexed for inflation going forward. One of the notable changes is, right, that the phase out rate doubles from 25 to 50%, meaning that AMT exemptions get clawed back more quickly for upper income filers. So overall, right, the changes preserve the broader relief that began under TCJA while tightening the AMT for higher earners and increasing support for families kind of through a larger inflation index child tax credit.
All right, switching to the estate and gift tax exemption. So this is the amount that a taxpayer can pass on to their heirs, basically tax-free or free from the estate or gift tax. This amount it's moved around throughout the years. Obviously, you can see that chart over that kind of shows where the exemption moved up and down. Well, this increased amount that happened in 2017 was made permanent going forward. So it provides a needed level of its certainty for those high wealth individuals that were doing or planning their estates and making gifts throughout the year. So good news there for those individuals. Okay, on to the state and local tax cap, or the SALT cap. So this is the basically refers to the $10,000 limitation that was put in place back in 2017. This limitation has been increased to $40,000. The one major caveat there is that, first of all, it is a temporary increase. It expires in 2020 or at the end of 2029. And also, it phases out. So for anyone in these high income threshold buckets, and you can look at the amounts below, you're going to phase out of that deduction. So you can be essentially back down to the $10,000 cap if you are making more than $600,000 a year. Charitable contributions, I'm actually going to skip over this one because I think Michelle is going to cover it in a little bit in her section. So let's move on to kind of we'll kind of end with this, kind of the qualified tips, overtime, and those provisions that you hear like no tax on that receive probably the most attention in the news right now. So what actually happened? Well, it wasn't no tax on tips and it wasn't no tax on overtime, but basically individuals, not the business, but the individuals will receive a deduction on their individual tax return up into a certain threshold. So both are limited to $25,000 for joint filers, whether it's tax or overtime pay. Now, for our business owners, and you can read there's certain rules and requirements here, but for our business owners right now, and anyone who pays overtime pay, so it could be not just on the business side, it's really, how do I get this information out to my employees? What do I need to report to them? So unfortunately, the IRS has already come out and said, we're not updating your 2025 W-2s. So the employees are not going to have a box on their W-2s that say qualified overtime or qualified tips. That will happen in 2026. And so for right now, the IRS has issued both guidance for employers and employees. And basically, it comes down to some, basically employers are not going to be penalized if they don't provide that information to employees. And employees can use a system, kind of a best guess estimate using the guidelines in the notices to try to figure out what their amounts of qualified tips or qualified overtime is going to be. Okay, so just moving on to the last two items that I'll cover before I turn it over to Michelle. 529 plans, those continue to get enhancements over the years. In the past, they were a simple tool utilized for paying for certain things in college. Now, every single tax bill, it seems like there's something that gets added on to that. So you can see here what the new rules are. They just get more favorable and favorable. Continue to see this as a great savings option for our client base. And then last on to the Trump accounts. Again, one of those areas that gets a lot of attention in the news because of its name. This is the new savings vehicle that operates similar to an IRA after a certain point, but basically you can contribute to those beneficiaries under the age of 18. And if your child is born between the years of 2025 and 2028, the federal government will chip in $1,000 of essentially seed money to that account. We don't exactly know how that process is going to work. They're supposed to roll these out sometime in 2026. And then the other interesting thing on there, I just think from an employer side, is employers can contribute up to $2,500, and it's going to be indexed for inflation per employee into the Trump account. So this is and basically the employee pays no tax on it. So if you're thinking about maybe some creative benefits planning to offer employees, this may be one way once we actually figure out how we can go about doing this. All right, so you can look through the rest of the slides. I think there's just some cost estimates here, but I'm going to turn it over to Michelle now to wrap things up for the non-for-profits.
Thank you, Tony. As Tony mentioned, I'm just going to touch on a few different ways that our not-for-profit clients are being impacted by OB3 and their donors as well. So beginning in 2026, not-for-profit organizations face a 21% excise tax on the amount of any employee's compensation exceeding $1 million. So it certainly doesn't apply to all nonprofits, but for those with comp packages at that level, they need to be aware of this provision. It's a significant expansion from prior law, which only taxed the top 5 highest paid employees. The tax now applies to any employee and the organization, not the individual bears the tax liability. When determining which compensation amount to use for the nonprofit executive excise tax, a good starting point is box 1 of the employee's W-2. But with all IRS rules, there are exceptions that can affect what's included or excluded from compensation. So it's important to work with a qualified tax professional to make sure you're capturing the right amounts and staying compliant with this provision. Compensation must be aggregated across all related organizations as well. So not just one individual nonprofit. If there's related organizations, you need to look across those. The tax is reported on Form 4720, Schedule N, which must be filed electronically. And of course, timely payment is essential to avoid interest and penalties. Larger institutions such as universities, hospitals, and national nonprofits are most likely to be affected, although it is worth noting that compensation for medical doctors and veterinarians working at nonprofits is only included if it's for administrative work, so not for actually, performing medical procedures, medical work. Finally, organizations should consider compensation planning strategies to help manage their excise tax exposure, but must ensure all arrangements comply with tax and benefit regulations. So ongoing due diligence and proactive planning are really critical to minimize risk and ensure compliance under this new law. I don't know how many foundations, university or college foundations folks are on this call, but I will touch on this one as well. Starting in 26, certain private colleges and universities will be subject to a tiered excise tax on their endowment investment income. The tax rate is determined by the value of the institution's endowment per full-time student, with higher rates for larger per student endowments. To be subject to the tax, an institution must have at least 3,000 tuition paying students, which is up from the previous threshold of 500 students. And more than half of its students must be located in the US. The endowment assets must exceed $500,000 per student, excluding assets used directly for exempt purposes. The definition of investment income has also been expanded. Now includes not only traditional sources like interest, dividends, capital gains, but also student loan interest and federally subsidized royalty income. Aggregation rules mean that assets and income of related organizations must be included in the calculation, so it's important to review the structure of endowments and related entities. Previously, the excise tax was a flat 1.4%. Under the new law, the rate is now tiered based on the value of the institution's endowment per full-time student. I think this one's probably pretty specific, so I think that's probably enough detail on that one. We can go to the next. Thanks, Tony. Beginning in 26, corporate donors will now face a new 1% floor for charitable contribution deductions. This essentially means that only the portion of a corporation's charitable giving that exceeds 1% of its taxable income will be deductible. As a result, corporations may want to consider bunching or consolidating their charitable gifts into fewer years to maximize their tax benefit. It's also important for corporations to model the impact of this new floor on their giving programs, to review whether some contributions could be structured as business expenses where appropriate. It's important to know that charitable contributions exceeding 10% of taxable income are still carried forward for up to 5 years. For not-for-profits, of course, it's critical to communicate these changes to corporate donors, although I'm sure they're very much aware of it as well. But you could also encourage accelerating giving before the new rules take effect in 2026. So this, may be an opportunity to reach out to your donor base. Because after that, campaigns really need to focus on, educating donors about the benefits of bunching and helping them plan giving to maximize deductibility under the new law. And then the last item I'm going to touch on is the impact on individual donors. In 2026, charitable giving rules changed quite a bit for individuals. For itemizers, only contributions above 0.5% of adjusted gross income are deductible. So smaller, more spread out gifts may no longer provide a tax benefit to individuals. Non-itemizers can now claim an above the line deduction of up to $1,000 for singles or $2,000 for joint filers, which is beneficial for cash gifts to public charities, even if they take the standard deduction. But given these changes, itemizing donors should consider bunching several years contributions into 1 year to exceed the new floor and maximize their deduction. So very similar to what we're saying on the corporate side. Donors may want to consider bunching and giving multiple gifts in a current year to maximize the tax benefit. Donor advised funds are also a useful tool for this, allowing large deduction now and making grants to charities over time. For donors in the top tax bracket, starting in 2026, itemized deductions, including charitable contributions, are reduced for income above the 37% threshold. This effectively means the tax benefit of these deductions is capped at 35% instead of 37%. So for high income donors, this is an important consideration when planning charitable giving and other deductible expenses. The after-tax value of those deductions is now slightly less than the top threshold rate. For nonprofits, it's critical to communicate these changes to donors and encourage larger bunch gifts, as we've discussed, and update donor materials to reflect new rules. Ensuring proper documentation and acknowledgments will help donors take full advantage of these new opportunities. And that's all I have on this. I'm going to turn back to Jim.
I am here. Wow, that was a lot of great information for our clients. We have this recorded, and as Tony mentioned, we'll have the slide deck. I think that'll be a fantastic resource for everyone to have on the implications and changes made by the OB3 Act. With that, I want to thank Tony, Paul, and Michelle for this presentation. Thank you. We've loved working with Raymond here at Kelly Cawthorn and really appreciate you providing this information for us here at Kelly Cawthorn and our clients. So with that, I will wish everyone, this is filmed a couple days before Thanksgiving, so I will wish everyone a happy Thanksgiving. And if you have any questions, just send them. You can send them to me, Jim Kirsch. It's jkirsch@kellykawthorne.com, and we will get answers to anybody that's on the call now or watching this on replay. So thanks again, Tony, Michelle, and Paul, and everybody have a happy Thanksgiving.
Thanks for having us.
See you.